All right, what's going on, everybody? Just getting everything set up. So give me a moment. All right, what's going on, everybody? That's running good. How y'all doing? It's Friday. Y'all have a good week? Yeah, for sure. Fire and hammers. I mean, I'm a big fan. Hey, there's heat in that iron. You just gotta swing the hammer enough to work it out. When I worked in the oil field, it'd be cold, and I'd tell the kids, get out there with that hammer and hit that pipe, got to warm up. 'Cause that'll do it. You broke up. I'm not sure what you said. Uh-oh. Now, nothing. I see she's trying to talk, but I'm not hearing anything now. I think she broke it. So, while she's getting that figured out, I uh, I had a pretty good week today. I didn't get much done. I mean, I'm day done, but I didn't get anything more than that. Working on this new broker. Um, you know how it is. It You got to be very cautious because it's not paper. So if I make mistakes, I have to pay for it. So watching videos and trying to figure out the settings and what it can and can't do. But it's all right, I suppose. Just like anything else, you got to get used to it. New brokers. I do like that I can change the font sizes to see things because I don't like squinting at the computer all day long. And it has some neat little things that make life easier. They have a very unique drawing tool that I swear is like a version of the way that I run extended drawings on my fibs. Theirs has the extended pieces built right into it. Let's see if I can find that thing again. Minotauro Move Up. I guess that's what it's called. But if you look at that, that's actually the downside. So 100 isn't showing. That's missing. I think it's just a setting and turn it on and off. But then it has the 129 to 1618, and then another leg up with the next zone, and then another leg up and the next zone. So that if you think about the way price moves, and you get those breakouts to where if we had price down here in a range and then it finally broke that range, then you get the pullback. I don't know, I'm missing my drawing up here quite a bit, but you get the idea that the next leg up and then it would pause and then the next leg up and then it would pause and then the next leg. If you've read any of the textbooks when it comes to price action and evaluating the next move in trend, the textbooks will tell you measure the leg of the move and the depth of the pullback, and then use that measurement for the next move. I think if I go to redo this, we'll put 100 in there because it's missing. So what the textbooks would say is if you've got price in a range, measure that range and project it, because once it does break out, the breakout can be measured and the pullback can be measured, and you'll measure the depth of each of those for the next leg. So this leg we would measure to see where the next stopping point is, which would be up here, and then that little pullback would be measured. And this drawing has just the whole thing in there, and of course you can tweak the settings to, I don't use 1618 for an example, and I don't use 129. I use 1236, but whatever, it's close enough. Their fibs were off too. They didn't use 786. They had something else. So I had to go in and adjust things. New platform, you know. But this pattern that we're getting today, um, I've made videos on it. It's so much a part of my world. We didn't follow through the way that we have in the past, but it's what I was mindful of. And we had this big bar, and that might have been why it didn't follow through the way it normally would. But in the past, I've found these midday wedges on the indexes. This doesn't count for equities, but it's a day where you're topped out, but you're getting these higher lows. And then after lunch, we get this big expansion to the upside, which is not normal. If you're not familiar, a flat top rising wedge generally is going to break to the downside. And with this one, if you do get a breakout to the upside, it's usually a fake breakout, fast failure, and you still get your short. But with the one that I've identified over the years, you don't short it, you run it. And a lot of times you'll get a Busby with it. I was looking for some of my old documents because I have videos on it, and I've got a lot of documented pictures, but I've been preparing this computer to get reset, and so I've removed a lot of my material out of it because of course I don't want to lose it all when it gets reset. So I couldn't find any of it. It's on the hard drive in the backup somewhere. The main thing is it didn't follow through. So we never did get the big breakout, and we're still just developing these higher lows and the flat top. So watch out. We got 2 hours to go, and I find it really hard to believe that we're going to hold between, say, 111 and 786 into the end of the day today. Hey, hey, what's up? Yeah, yeah. Yeah. I was thinking today that we might actually go do a deep dive too into the broader market and take a look at some of the risks that are out there. At the moment, though, at the moment, with the way that we are, um, as long as we're keeping this breakout, then I'm bullish. And the way that I talked in my live stream today kind of reaffirmed the idea that I know there's a lot of scary things out there, and they're hyping those scary things up because they want to increase uncertainty and they want us confused and they want as many shorts as possible in the market. But we just keep going up, and it's what we've done since April. And they are banking on all of that fear and doubt and confusion, and yet we're still hitting. We're still hitting and going to the upside. JP Morgan has highlighted all the buy side that's supposed to be there for the next 12 to 18 months. There's just all this aggressive hype into pushing this market higher, and they're pulling forward valuations and earnings from 2026, 2027, and in some cases like Nvidia even into 2028 already. I would not short into that. But on the other side of it, we still need to balance our risk. So downsizing or trading in a reduced position size is appropriate, or keep things balanced, which is my approach. I don't like to own hedges. They're just a waste of money. But I don't like to sit out either because, well, I got to eat. So if I stay balanced between my longs and my shorts, then my long term account can just continue to be good. And then my shorter term stuff is just me trading into or out of whatever I like on a shorter duration basis, less than say 6 weeks to 2 months. I'm in and out of things as I see fit. For the longer term account, though, balance is best, or reduce position size is a good way to go because we still do have a lot of risk. You know, off there's Europe's a lot to unpack. I'd say give me until the next meeting to have something to dial in on for Europe. Other than it, the energy crisis, the blackouts, factory shutdowns, German elections, that's all created a lot of drama over there. But give me until, and then one tip I've had with a lot of my coaching clients that are overseas is we all get really complacent in America because we got so many ETFs and so many choices. And in whatever market you're in, whatever country you're in, try to find a broad market ETF that helps. And then try to find an inverse ETF so that if you don't want to play options, or if your account isn't allowed to short stocks, because that's a handicap for a lot of people, that if you have the inverse ETF, then you still buy that like a regular stock. You would buy in to open the trade and you sell to close the trade. So you don't have to worry about, borrowing shares just to short a stock and paying all the fees and commissions. But then that gives handicap because some accounts aren't allowed to do that, to trade those inverse products, or the margins are increased. There's always something, right, that gets you coming or going. But if you have a local nation ETF that you can focus on. That's a way to consolidate your risk. And then it has just one thing for you to focus on in that risk as a hedging vehicle, or really get more comfortable beta weighing. I know it might seem like a very complex thing, but if your long term account remains in a balanced state, then your big picture risk is reduced significantly. Something to really keep in mind. And over the long term, the markets do just go up. So you don't sound old, no offense. I mean, you don't sound like you're 90. So you shouldn't need your retirement next year, unless you want to just bank it early. And if we do get a drawdown in your account in the big picture, you should be okay just to hang on, maybe even add a little on the lows. That's certainly what I'm going to do if we get a big drawdown. I'm just going to add in on the lows. But not it. Yeah. Oh yeah. Yeah, I got a couple clients that act like the things that they buy, they want to hang on to it forever, and I hear them make comments like, "Oh, my grandkids are going to love this." That's just not me. I want to lock in gains, I want to take profit, I want to make money. Even in my long-term accounts. They're not buckets of things that I'm going to hoard in the afterlife. So, yeah, locking in profit is absolutely a good thing, and cycling through as things change. I can't remember the last time my long-term accounts were all cash, but there are periods of time where I'll cut it down to, say, even 50% if I feel that we're in a serious regime change. And that regime change can come from things like the direction of the FOMC or the direction of the government itself, the entire government changing course. So we haven't had anything like that since COVID, but yeah. Yep, I think you're on the right path too. For anybody though, looking into beta way, and even if it's not the classic specific beta weighted portfolio, if you do just consider how many trades you have that are relying on a market that continues to go up versus how many trades you have that might need the market to go down, you'll probably notice that your long term accounts are all pointed to the upside. And that, of course, puts all of us at risk. So if you can find some balance somewhere, fixed markets, CDs, just something that's collecting interest at 6 to 8%, that's not a bad way to go. Just to kind of reduce risk and stay in the market at the same time. But it takes a while to get to that comfort level, and then staying alert to the big picture risks. But in the U.S. markets, while we have a lot of things that make it look risky, and yeah, we do have risk. Everything's still pointing to the upside. So as long as it is still pointing to the upside, I would not recommend liquidating just because of the threats. And we do have some threats. We got QRA coming, FOMC. We have, in my opinion, a real threat to our credit situation. If the US gets a downgrade in credit, I think that's going to be the straw that breaks the camel's back. When I was running a search right here in the Discord, no less, on the last time we had a credit downgrade, it was by Moody's in April or May. So what you would want to do is in the search bar, choose user, and then I chose myself, but because I knew I had made comments, and then I used the word downgrade when I found it last time, but now I know it was Moody's that did it. So you could type in the word Moody's or downgrade, and in the search, it was from May. And I had some comments that went with it, and it talked about Moody's was threatening a downgrade because of the House and the Senate and the um, really high level of our debt. And they said this is really unsustainable. You guys need to, dedicate yourselves to resolving the problem and put in a downgrade. It's interesting now that I scroll back that there was also comments about the European Central Bank and their monetary policy. So I just caught that when I went back to look. But to me, if they were willing to threaten us with a downgrade back then, and I think they actually did give us a downgrade back then, over the idea that we could possibly shut down. That was one of the comments that they had made is they were doing the downgrade to our credit because of the risk of a government shutdown. Well, we actually did shut down. So now what? Are they going to give us another downgrade? I think if they do, that'll be the what finally breaks this stalemate in the government because no side seems particularly interested in actually solving the problem. They're all both sides seem very happy to just point fingers and cast blame over why we have this problem. Nobody is stepping up to solve it. And that might be the problem solving solution, another downgrade. I also think it'll whack us pretty hard. Now, did we fall very far on the last downgrade? I don't think that we did. Right? It was this year, and I mean, look at this year. It's been phenomenal. So the downgrade may have been right around the time that Trump was doing his thing in this April May time frame. And where's the action in the market that was a part of that downgrade? Maybe it was this drawdown here. Maybe it was that one. It didn't last, but we're in a different environment now. That getting a downgrade now might hurt worse, or it might be responded to differently this time. We just have to see how it plays out. But in my opinion, getting a downgrade is the biggest threat to the government. And I think it's one that people aren't aware of. We all know FOMC is coming. We all know CPI is coming, or not CPI, but QRA. Those are known unknowns, and the market almost never falls from an unknown or a known unknown. Those kind of COVID type falls. We almost never get that sort of a market reaction from something we saw coming. The biggest market falls in history were from surprises where everybody's suddenly, oh wow, oh no, and then an issue arises like a credit downgrade. Plus, they can just push the button and give us that downgrade whenever they want, right? Like they just have that Coles button that says that was easy, just sitting there on their desk, and anytime they just reach out and hit that button and give us a downgrade. That's a lot of power in the hands of one person or one firm, and they can use it politically at the worst possible moment too, if they so care to do it. There's also more than one agency, right? There's Fitch and there's Moody's, and then there's one other one, but I can't remember the name at the moment. If you was to hit AI or Google and talk about U.S. credit ratings, you'll find the three names. I just can't remember what it is, and they all aren't equal weight, right? Just like the Three Stooges, one has more relevance than the others. But I think any downgrade at this point would not be favorable. I snapped a fib on that fateful Friday, and we can see that it's 68.36. If you move the level just to the previous high, instead you get 68.42. And 68.42, well, 42s are an old cog line. They're still relevant levels. I always pay attention to a 42 just in case, but it's not a valid cog line anymore. It's worth keeping up on the idea that this market needs to pull back now that we've had the breakout and we've gotten to the 111. We could overshoot it and go ahead and get into the 1, 2, 3, 6 first and then pull back. Or now that we've gotten here, we could just pull back. On this time frame, because I'm on a daily, if we pulled back from here, what it would most likely look like is that this candle closes, we get a new one, maybe that one has a wick on it, and then we form that candle shape with that wick there. That would be the best outcome for everybody, I think. Otherwise, if we gap up and we get one of those kind of gap and go bars, then we could end up, leaving a wick behind and then closing somewhere down here, or worse, closing all the way down here, and then let it get nasty really fast. We don't want to gap up on Monday. I guess that's what I'm trying to get to. A gap up from here would not be good. That'd be a gap into exhaustion, and uh, it could play out, but most of the time, if you get a gap up from the highs, it's not a good thing, and so we want to avoid that on Monday. But a pullback from here should not be a crash and burn. Should be into something like 67.50. That would be at the worst at that level. And then after a pullback, another leg up, and that should get us up into 76. To play it out, though, if we don't fall back, we go ahead and run up, we get into the 1, 2, 3, 6, and then we get an OCC, and then we'll move the drawing up. So we'll just move it now to kind of preview what that would look like. It was right about there, 76. The next one up would get us into 67 or 7,000, excuse me. 69.55, that's pretty close to 7,000. Why 7,000 is all the way up here? I guess maybe I'm a little off, but you see where the next level would be. And then, of course, you just do the fib again and again. So we're still up there. And that is the main takeaway. We don't have any candle chart of the indexes that signal risk. Now we need to look at other issues. And I've got a platform for that. I'll bring it up. We had a request, though, to talk about a few things today. One of them being event bars. And event bars, they do look like a leg out. They don't always have to be, and they can happen at any time. But for the known event bars, you do want to treat them differently than just some random event. And I say that because we actually had one earlier this week on Wednesday in the middle of the day. We got an event bar right there. And I treat one of those events completely different than I would treat a known event bar like CPI, PPI, non-farm payrolls, because those are different. We all seen them coming. We were all prepared for them. You get something like this in the middle of the day when just wow, bang, there's an event bar. You still want to use it. It's a gift. It's giving you structure to work off of. So at the bare minimum, capture the high and the low and capture the close, capture the open. Since the open is the gap that we need to close, that's what you want to focus on. Now, this one isn't a good example because we closed pretty much where we opened in the same neck of the woods. But if we had closed all the way down here, that would have been a completely different story because where would we go? Back to where we started. Either way, once you have the event bar, you have to start considering one, what happened, and then snap your fibs. This one stopped at a 111 or a 1, 2, 3, 6, but I gotta say, in my experience, most of the time they do not. If you get a big event bar, 111 and 1, 2, 3, 6 get run right the heck over most of the time. So be prepared for that to happen. Now that doesn't mean I take them off. I leave them on there, but I'm not sitting there dead set on the idea that price is going to stop at 111 or 1, 2, 3, 6. Instead, I'm really expecting it to break right through the 1, 2, 3, 6 and keep going. And when that happens, I'm expecting 1.5 as the pause point or as a full move as the price point. That's straight out of the candle textbooks, by the way, that when you have a range and that range breaks with uh, a lot of volume, then you want to measure 50% and 100%. And that's why we're doing this, because those event bars are usually triggering stops. They're triggering fear or excitement. That's why they went off in the first place. People were surprised, caught off guard, caught on the wrong side. And we get these wow events. Some of it's algo driven. That's a lot of fuel in the fire. So don't expect 1, 2, 3, 6 and 1, 1, 1 to stop price. It'll just run right through them. So we do want to treat them differently. But now that we have them, they define our range, our structure. Then we put our measurements around it. And freshness matters. It's not a word we really talk about that much, but freshness matters. If you've got a zone, a range, a level, and it's 10 minutes old, it is more valuable than the one from 2 weeks ago or 2 months ago or last year. So the freshness matters. It should be on your radar. The question about the event bars is the relation to the halfback and the whole. Well, if you think about this example wasn't a very good one because we came back to where we started before the candle closed. If we had not, then that event bar would have been a gap, a liquidity gap. And the expectation 100% is that, yes, we're going to try to close that gap. It doesn't mean we will. I've got plenty of examples where we don't, not that first day, but I'll carry them forward until later to see if later on we do go back and get it closed. The one from 2 Fridays ago, this really big bar, I carried that forward until we got back up there and hit it because it's where we opened. It's where I expected us to go to get that gap closed. And eventually we did go back there and get it. So you do want to highlight those halves and those holes and then measure that structure and present it higher and lower to give you clarity on where we should go if we break out. And if we stay range bound, where's the midpoint so that we can say we're, you know, not looking for shorts if we're still above, and we're not looking for longs if we're below, that we would have to break the structure from above to below to get a continuation lower or vice versa, right? So like today, you can short from here to here, but that's just a little scalp, right? From one line to the next. If we're above the white line, I wouldn't be aiming for the low of the day because we got to get through the midpoint first. And that's a big picture perspective. That's just not event bars. That's any kind of range that we deal with. If I'm looking at yesterday's range and I'm trying to define what we're going to do with it, as long as we're still inside of yesterday's range, I'm not going to be looking for some bigger breakdown target all the way down here. We got to get out of the range first. Once we do, then it's game on. But if we're still in the upper part of that range, because we'd mark it in half, 50%, not looking for shorts at the low of the box. I'm only looking for shorts that can get to the midpoint of the range. We have to get underneath the midpoint before I start targeting the low of the day. There's an old fib concept that will help with this, and it works for any pivot point, by the way. If you have a set of lines, wherever those lines happen to have come from, we call it opening it up. So, what is opened or what is valid as a new target? If this is the range that I've got and I snap my fibs and now I can see overhead 111 and 1, 2, 3, 6. Well, 1, 2, 3, 6 is not a valid target. We would have not even 111 isn't even a valid target because we're not yet above 1. Once we pull back to 786, which I took off, it's not here. Once we pull back to 786 and we start running up, the target is 1. Get above 1 and you've opened 111. Get above 111 and you've opened 1, 2, 3. But you can't identify those as your next target if it's not open yet. That'll work for anything. So when we apply that back to any normal trading day, take our own Globex. If we're inside the previous day's range, then we have to get outside of that range before we have any other target. So we have to open it up level by level by level Once it's open, then we can set a next level higher, get to that, then it's open, then we can set the next level higher. And that's how we want to play it, right? It's not the idea that we're just playing, I don't can't remember the name of the game, but the goal isn't just to go from line to line. It's to use the lines and the levels and the analysis to better understand what's happening in price. I don't know how you trade, and you being anybody who's listening, I don't know how you trade, and you don't know how I trade. But for me, these lines and levels are not the trigger for me to get in, to get out, to adjust my position, or to do anything else. They're just a line that helps me better understand my anticipation or my understanding of price. So when we get there and we turn and we come back in, that alone is not a tradable trigger to me. That is just confirming my belief that we were supposed to turn there, and I will start looking for shorts at that point. Or if we break out and we start running, that's not a trigger for me. That's just confirming my understanding that, yep, we're breaking out just like I thought we would. And now I have permission to seek long opportunities because we broke out. You have to come to terms with your style of trading to figure out what these lines and levels are going to be for you. And any line or level, MACD, stochastics, RSI, whatever it is that you use, your definition of the trade has to be based on your understanding of what you're expecting to happen next, which is hard for new traders to articulate because they're new, right? It's hard to explain something that you don't even understand yet. So everything that we do on a normal day-to-day basis, where we mark yesterday's high and we project the 111 and the 1236, you can use that tactic on anything. We've been using it on this pullback on the daily, and sometimes I'm just using it on that one big bar. And of course, we're using it on yesterday's price, but we can also use it on the entire year because that's what the textbooks will tell you to do. Go out to a yearly and run it all the way down to here. But we can also run it on just last week's range. We can run it on the monthly bar. You can run it on the last hour's bar if you want to. As long as it gives you a better definition of what price is doing now, helps you better understand where we came from and develop a plan for where we're going next, then it works. All you have to do is validate it. Hopefully, we're going to have time today to start getting into some validation talk because I think that this would help any trader, if you have a better understanding of what the hell are you trying to trade. When I ask people what they're trying to trade, I get a lot of strange answers. A lot of strange answers. What are you trying to trade? The breakout itself, the run, the target location? How did you know that that was supposed to be the place that you were getting in? Why did you get in there? Why didn't you wait? Or why did you wait? Why didn't you get in sooner? And a lot of the answers are strange. Maybe it's because you don't have the words to articulate it. And I get that because it is hard to explain why I like my pillow so much. I can't. I don't have the words, but I really like my pillow. I need to get a magic 8 ball. I keep saying I'm going to get one and I don't have one. But you should contemplate what is your trade? What does it look like? Can you draw it? Can you draw what it's supposed to do? And if you can't see it, if you can't visualize it, if you don't quite grasp the logic of it, what are you looking for on the chart to tell you it's time to get in now, here, at that location? And then how long should you hold it? What's the expectation for that? The half and the whole starts in Globex for me because my day starts in Globex. But for an example, I know traders who start their day around noon because they're at work and then they got the kids and life gets in the way. So your midpoint or your first box should start with where are you coming in to trade at today? So since we always in the live stream do a 7:30 live stream, my first box is Globex. But if you're coming in to trade and it's already 10:30 in the morning, your first box should be the RTH, right? Because that's where you're starting. Not you, but wherever the person is, right? And that's a real fair, honest question. I like the question because how would you know if you didn't ask that one? But I've got a client who starts at noon, and me and that client had a long talk about where do you start the box. And he starts his box on the RTH because he does literally come in at noon, and that's fair, right? Me, I start in Globex, so my box starts in Globex. Even if you did start in the daytime, the box that you have for that session, whether the session is the RTH or the Globex, that becomes the first box that you have to get out of before you do anything else. So in this situation, if we go to the upside, we got yesterday to deal with. And if we go to the downside, we got our Globex to deal with. That would be the second box, Globex. The RTH is our first box, right? So it's always just a matter of where are you when you begin to draw the drawings for the day. You know, I share this one sticker that I made. I'm not a big fan of I am not good at drawing anything. I have so much respect for artists, mainly because I couldn't draw a stick figure if I wanted to. But I made this sticker and I was really happy about it because you know how difficult it is to make an animated sticker? It's kind of hard. But I wasn't excited about the idea that I knew what my trade looked like. I know what all my trades look like. It was just the fact that I was able to make it animated and put it into the Discord for everybody. Imagine drawing out your trade. What would your trade look like? Where's your entry? Where's your stop? Now, of course, you can dig into it deeper and deeper. This was just a little sticker, and I was limited by, how much I could put into it. But if you was to draw out your trade, what does it look like? Swing traders, of course, have that completely different. But for day traders, so what you want to do that I find very helpful is go back in the past and find examples of your trade. It doesn't matter that you didn't trade it, just find examples of the trade that you're looking for. And that's what you're trying to find. That's the trade. Study it, examine it, memorize it so that you know exactly what your trade looks like. I call that developing trust, right? We have to trust that the thing we're trying to trade exists. We have to trust that it is going to show up often enough to be able to make money on it. I call that occurrences. And we have to trust in our ability to recognize that the trade isn't working so that we can get the heck out as soon as possible and not just rely on stops, right? Because, yeah, stops do their job. They get us out of the trade, but we have to give stops room. And I don't want to give them room. I want to just get the heck out of the trade if the trade is not doing what it's supposed to do, or stay in the trade as long as the trade is behaving the way it's supposed to behave. I've got a file. I'm looking for it now. I didn't think it would. Oh, I cleaned out my computer and it's driving me nuts. I got a file of 111s, yesterday's 111. And I went back for 6 months. I zoomed into the chart enough where I could see yesterday's price. So let's just start right here. I can see that day's price. So I snapped a fib on it and I went to the next day and I started marking out 111s and 1, 2, 3, 6s. That was my only goal, right? Just mark it out and see, hey, what did the next day do? Did we get a 111? Did we get a 1236? And if we did, then I, cleaned up the chart to where only those 2 days were showing. And I took a picture and I added it to the file. And then I went to the next day. In that picture, I made sure that there was a date showing so that if I wanted to go back and examine it in more detail, that I could do that. And I have a really nice collection of 111s, and I have a lot of trust in that strategy. It pays me more money than any of the other trades that I trade, and it happens frequently enough. So here's yesterday's price, only the RTH, and there's the 111. I didn't cherry pick that, right? I just scrolled back as far as my chart could go, and I found the first breakout that had a short reversal, and I measured it to see, hey, was that reversal a 111? Yep, it sure was, just like that. So this is one of my favorite trades, right? I study this thing with every new tool that I find, options flow, uh, the dome, order flow, anything that I can do to understand this one trade more, I do it. And you can be amazed at how much more stuff I can add to this, right? How it turns. Was it a 2 bar reversal or a 3 bar or a swing high? If it was at the lows, was it some sort of double bottom or capitulation play or triple bottom? The more I can add to this trade and understanding what's happening in price, the better. So think about your trade. And if you have more than one, that's good. The more the merrier, because this one doesn't happen every day. So if I have something else I can trade on days that we don't get this, well, that'd be great too. What's cool about this one is this is 111 from yesterday, but I can take that same 111 strategy and I can use it on the intraday. There's from high to low on the intraday. I missed that high. Zoom in there a little bit. If this was the high of day, we set the high and we pulled back. Where did we go? To the half. And then we ran back up. We checked the high. And what did we do? We tried for the 111. Now, we didn't quite get there, but it was close enough. And besides, I don't draw my drawings from the highest to the lowest, anyways. This actually would have been drawn if I was doing it the way that I do things. That right there. Really nice 111 reversal. So my technique for trading the 111 of yesterday also works on event bars, 5 minute open bars, intraday high to low bars, even using intraday swing highs and swing lows rather than the entire day's high and the entire day's low. I can use this tactic everywhere. And so I do use it everywhere. And I experiment and try new things all the time with this same drawing. I try it on all sorts of stuff. So once you do know what your trade looks like, can you adapt it and apply it to other circumstances and other markets and other time frames? If you can, then you can turn one trade strategy into 10, 12 different strategies, all building on the same one so that every new thing you learn about that one trade helps you trade all 10 of those better and better and better and better. I've been trading this one trade strategy for years, so I know a lot about it. Try to put as much into your one trade, knowledge wise, as you can to complete it to the absolute best of your ability. And when it isn't working and it's failing, if you understand what failure looks like when your trade is not doing what it's supposed to do, the word failure isn't to imply that you are failing or that you're doing something wrong. It's that the trade is failing and it's not doing what it's supposed to do, which is fine. You can just get the heck out or get out of the way and never get in the first place because it didn't do something, whatever it was supposed to do, it didn't do it. And that way you don't need to wait for stops or triggers or alerts or anything else. It's just not looking the way it's supposed to look and you get the heck out. This same measurement here is applied to the Globex high and the Globex low. And there's our reversal there too. Nice little 111 reversal, and then really close to a 1236 reversal. Of course, by that time of day, I would have already updated my drawings, but still, there it is. Why? Because it works. So you can't break it. You can't do it wrong. Apply it, analyze it, fiddle with it, move it around, test the heck out of it, go back and find old examples of it, collect as many of those as you can to have more trust in one, your ability to see the trade, two, in your ability to understand what that trade is supposed to do, and then three, recognize when it's not behaving so that you either stay the heck out or you can get out as soon as possible. It works. If you can afford it, Edgeful has tools that can help assist with occurrences. That's the word I like to use, but how often a thing happens, whether it's a gap close play or whatever, they've got a lot of stats if you can afford it. But even if you can't, you can just use the go back, right? Just you just zoom in and you go back one day to the next, evaluating what we had and looking for the thing that you're looking for, like these event bars, if that's what you're interested in. Build up an entire database of the trade that you want to take. It will help. Oh, that's a video. That ain't it. You don't have to reinvent the wheel. You just have to get to the point where it works for you, right? And if you can tweak the settings just a little bit so that it works for you, then now it's yours and it's not mine or anybody else's, right? Once you tweak it, you own it. And that's where the gold really starts to happen. The problem with seeing something work for somebody else and saying, "Well, I'm going to do that because that's what that guy does." That guy has however much time they spent learning it, 6 years, 6 months, right? And you've got your new recognition of it, 6 hours, 6 days. All that history and trust that I have in a pattern, you don't have it yet, right? Because I got history with that pattern. You can see that I like it. You can hear me say that it's my favorite, but until you've till you trust it, you're not going to trade it the right way. When I try to trade a pattern that I don't trust, I get out too soon. I sit out when I should have gotten in. I misread it because I don't trust it and I don't know it. And I screw up with it because I'm not doing all the things that I should be doing because I don't trust it. And so you got to build that trust. But it's your trust in the pattern and then your trust in yourself. Confidence is a burn, man, and it screws with all of us. If you lose confidence as a trader, it is so hard to get back. Confidence in yourself is bad enough, but confidence in a pattern too. You get one that lets you down and really burns you, yeah, it's horrible. So you don't want to break that trust, right? But then you gotta have it, or the pattern, the trade doesn't work. Plus, the really cool thing is how it builds. If you put in a lot of work on a pattern, the work from that one will build into another pattern. You learn tips and techniques as you're going through the work so that the next pattern is faster. Your data collection becomes smoother, more detailed, and then it's just right repetition. And the better you do, the better you do. It's kind of like journaling. When I first got here, everybody talked about you got to journal, you got to journal, you got to journal. And I tried. I tried everything: Excel spreadsheets, written books and paper. I tried to buy some journaling platforms. Nothing worked. Nothing worked. But I kept trying. And every time I'd last a little longer, I would do things a little different. And so I learned a lot about what I wanted out of a journal, so that when I finally got it right, after all the trial and error, which felt like a waste, it wasn't. It was just a learning experience. Now I've got this fantastic journal system. And I've had people say, "Well, just show me what your system is and I'll do that." I can't. It's got all of my errors and all of the mistakes that I've made and all of the deleted ones. I bet I've thrown away 20, 30 different journals. They're gone. I didn't keep them. But the journey got me to where I am with my really good journal now. And by the way, if you guys don't know, my journal is pictures. I figured that out for myself. I love pictures. Pictures for a journal are excellent so that you can go back and look at what your trade was. Just getting in and getting out and having the numbers of how much money you made or lost and how big your stop was, to me, that is a worthless journal. It has no value because my broker can give me that information. I don't need to document it myself. And two, if I look at it a year from now, if I go back and look at, oh, okay, April 2nd, 2023, I had 5 trades, 3 were winners and 2 were losers, and I made this much. That has no teachable knowledge there for, well, what kind of day was it? What kind of trade was it? But the picture, the, you can learn something new and go in the past and see one of your old trades and see the new stuff with your eyes that you couldn't see before. And everything you learn can be applied to all your old trade pictures so that you can look at your old trades and see something else in there. It's such a great tool to make you a better trader. And it's fast because I can't spend 3 hours writing in a journal. I don't have time for that. All right. Uncertainty, like we are in right now, we are not going to find answers from one source, right? And even we're not even going to find all the answers because there's just some unknowns in there, right? But there are some tells along the way that we can use to better understand how's the state of things out there. Some tools like ratio charts and that sort of stuff. So if you guys have something that you want to dig into, by all means, throw it on there and we'll dig into it. If you don't, I'm gonna just take a look around out there and see what the risks are, or if there's any signals of risk that we need to be aware of. What we're looking at is IWF and IWD. Funny enough, that's the small caps growth versus value ETFs. It's weird that we would use these because this is a signal for Mag 7 trades. If you're thinking about holding Mag 7 or getting into Mag 7, this is a really great indicator to help you make that determination. And yet it's small caps growth versus value. I don't know why it works, it just does. So this is a really good tool to help you decide, should I try to short the Mag 7? This says no, you should not try to short the Mag 7. Right now, the short term line in the sand, what we call the swag line, is 230. A deeper, more solid line is 2.28. It's this previous high back here from August. As long as we're above those levels, you do not want to try to short the Mag 7 collectively. Individually, if they get to misbehaving, sure, why not? Now, there are some worries because this indicator down here is making lower highs and lower lows, and it's threatening to break down below 20. So that is a concern. It's divergent and it looks weak, but it hasn't broke yet. And look at this pullback from August when it did go down to 20. We're at 20 now and we don't have any kind of depth of pullback like we did back here. So this looks more of like, when you see the runners and they squat down and they put their feet against that little starting position wedge, like they're priming to push off and really haul butt. That's what this looks like to me. Like it's pressing its foot into that starter block, waiting for the pistol shot. I wouldn't try to short into the Mag 7 with that signal on the MACD or the stochastics. I think that's a stochastics. But I wouldn't try to short that signal. Plus, we're still above the swag line. So no short in the Mag 7 looking at this. And of course, everybody's going to say, well, it's earnings, and yeah, yeah, dude, absolutely. Earnings month, markets generally go sideways for the earnings month because we're all sitting out, we're waiting, and we don't know, and we want to see what the risk is. But that smart money group, there's some cheating bastards, right? We all know they cheat. They've got inside scoop, they know friends, and they're all looking over each other's shoulders. If there was something systemically wrong in the Mag 7 group, collectively, they would have already started trading into it. So either they're all as ignorant as the rest of us and would have no clue, or there's just not that big of a risk because they're not shorting them. And if they're not shorting them, then there must not be anything wrong with earnings. Other than, we could get a surprise. Of course, we could get a surprise, but we're talking about something real big, fundamentally wrong with earnings. Can't see it here so far, right? And individually, earnings estimates look really good on things like Apple and Meta. I've seen some really positive write ups from known analysts who aren't just paid mouthpieces, who are happy with Apple, Meta. I mean, the burn in cash is hard to chew on, but generally speaking, they got positive things to say. This says don't short the Mag 7. Now, this other one, this is also growth versus value. And I went hunting to make this because when I found out that this growth versus value is really only useful for the Mag 7, then I thought, well, I still need a growth versus value indicator. So I went and got this. And in my opinion, after I made this and compared it with all the other growth versus value ratios that I found, this is the standout. It does its own thing, it doesn't mimic the others. I can build 5 different growth versus value charts, and they'll all look like this to varying degrees. This is the standout. So I use the one that doesn't do what the other 4, 5, 6, 7 of them do. And this is indicating that there's a change in the growth versus value dynamic. Now, if you're new to this logic of growth versus value, the Mag 7 is growth stocks. They're supposed to be, high flyers, big gainers, movers, and they're broad, they're strong, they move things. Not only do they move things, they move others. These growth stocks are considered risk. And if the market is willing to take risks, then the market is still positive and we expect the markets to go up. So growth is the Mag 7 and other growth oriented. You'll want to check they've got a nice little write up out there about what a growth stock is, how to quantify it as growth. I think that gets too much into fundamentals for just a regular trader. Fundamentals, you can have fun with that. That's a good 6 month, 1 year course. But growth in general is risk. And if growth stocks are going down, the market is stagnating. It's at risk for things like recession fears and that sort of stuff. And when we do start going down, say 2022 bear market, you'll often notice that growth lags badly over value. But when it comes to this ratio chart, don't mistake this to mean that one is going up versus the other going down. You can have growth and value going up. You can have growth and value going down. This is about outperformance. Which one of these is outperforming the other one? So when growth is leading, when it's doing better than value, this indicator goes up. And when value is doing better than growth, this indicator goes down. But it's easy to forget that and to to think, oh, it's going down, value must be dominant and growth must be going down. Nope. This isn't a dichotomy between this market going up and that market going down. Just that one might be going up a lot and the other one only might be going up a little, right? So when this indicator is falling, value is outperforming. And when the indicator is rising, growth is outperforming. And the entire stock market will do better when growth is outperforming. And that's what we want to keep in mind. This is weakness. This is weakness to the broader market and is indicating that value stocks are coming back into play because it's pointing down. Value collectively is outperforming growth. Pepsi, Coke, IBM. I don't really like IBM in that example. That fits into tech too much, but definitely something like Staples, Pizza, Walmart, Costco. Value is outperforming growth. So there's a little bit of money rotation there. It's not a flight to safety because it's not crashing and burning like this, right? That's a flight to safety. That's like fear all packed into one. On the IWF, I didn't use any ratio, so you should be able to just type in IWF / IWD. That's all it should take. No weightings in there at all. And then for the numbers, you don't need all these lower ones. These are just like little noise. The only one that you would really want to mark on your chart would be drama 2.22, previous high 2.28, and then the round number 2.30. If we get to 2.35 and stay above it, move the 3.0 up to 3.5. If we get above 4, then move it up to 2.4 and just keep moving it up in increments of a nickel. If we do move up along the way, we'll have to move drama, but right now drama is still 2.2. It's the previous level here, which goes back, I believe, to another level. Oh, my chart doesn't go back far enough, but there's one on stockcharts.com, I think, that goes back into like 1980s or 90s or something, and there's a reason for that drama level. It doesn't even line up on something if I'm on the daily. That's funny. So yeah, just a / IWF / IWD. And I have a stochastics down here. I don't think I modded that one either. I like my stochastics for analysis, but you could swap that out for RSI or MACD. There's a lot of indicators that can replace stochastics. I'm running an 80/20 with a 50 mid-band, and my inputs are 5 and 5 with a 14 look back. If this was Thinkorswim, I believe it would be 1-5. Oh, I guess I'm running a 5-3. I thought it was a 5-5. On Thinkorswim, it would be, but I thought this one was calculated different. Maybe not. K to 5, D at 3, 14 period look back. And you can swap 14 to 21, gives you a full market month. I don't think it really adjusts the ratio that much. All right, there's not much here to see, but it's worth pointing out. There are a lot of tools out there, right? Like VIX. VIX is a great tool. Well, this is TDEX, and it is owned by, I believe, the CBOE. So this isn't even a ratio, it's just a word, TDEX. It's the nation's tail dex. And off the cuff, it's showing you, are puts more expensive or are they cheaper? And where were they yesterday? So it carries it in a line on a day-to-day basis. When I see the VIX moving, say, higher or lower, I want to know what's the cost of those puts in general in the S&P which is what the VIX is looking at, when people are buying S&P puts and volatility is rising because they're buying those puts, how much are they spending? Is it more or less? The best analogy I can give is, what's the gas price? The average gas price. And is it higher or lower? Right? Because if it's $5 a gallon and you're like, gosh, $5 a gallon, you're killing me. Maybe, but if it was $7 last month, you're probably pretty happy with $5 a gallon. So we kind of want to know, when we go to buy puts, or when puts are being bought a lot, are they expensive now relative to, say, what they were last week, last month? You can do IWF, IWD on Thinkorswim and on TradingView. Here I'm going to create a new layout. I will just start with, I don't know, Apple. So there's Apple. I want to go up to the top, click that button, IWF / IWD, IWF, IWD, hit enter. There's IWF, IWD. Now that I've created it, get rid of the candles, turn it into a line, and there is IWF with IWD. You see? The numbers are all the same, everything. I look at it on a daily. It's useful on a weekly too, but I don't leave it on the weekly. I'll jump over to a weekly and I'll look at it, and then I put it back on the daily. If you look at it on the weekly, I really feel bullish when you look at it on the weekly, right? Because I mean, look at if we were talking about a stock and it looked like that, tell me you wouldn't be bullish, right? So I look at the weekly, I just don't leave it on the weekly. I leave it on the daily. And I never go below the daily because I have no interest in it. I don't know if it would even, I don't know what value it might or might not have. I don't want to say that it won't be valuable, just that I never do that. I have a stochastics down here, and this is an anchored VWAP for 2025. It's anchored in January at the first of the year. Just because at a glance, not necessarily this one because I already know, but at a glance, is a particular symbol that I'm looking at above or below its year to date VWAP. This one is well above, and there's no reciprocation issues or anything like that. So anchored VWAP for the year, and a stochastics down below with a 5.3. But the stochastics can be swapped out for whatever you like. It can be a MACD, a stochastics, an RSI, whatever suits you can be put down below. I just want something that gives me a way to gauge divergence between participants, right? And if you go to something like stockcharts.com, they've got this class, or what do they call it? Chart School. That's what it's called. And they do really detailed descriptions of different indicators. And they quantify them into categories, right? Now, you don't need an account to go to Chart School. Um, it just won't remember your settings, right? So you'll have to keep going back to it again and again. I have an account here, so I can go to it whenever I want, but you don't need an account. So in this really good article about multicollinearity, which is just a real crazy crazy term. It's talking about how when you have a bunch of indicators, spread them out into different groups so that you don't have this echo chamber of five indicators that are all bullish. And then you later find out that all five were looking at momentum and none of them was looking at trend or volume or volatility. So, try to pick one from different categories. When it comes to stochastics, we're looking at the momentum category. You could choose CCI, RSI, Williams percent, trend, tricks, ultimate oscillator, the Arun, which I hate that thing. You could just use the rate of change indicator, which is one of the oldest indicators that's existed. It's even older than moving averages. And that way you spread out your collection of tools to cover one in momentum, one in trend, one in volume, one in volatility. So IWF, IWD, that is a really good Mag 7 tool for swing trades too, right? I don't think you would want to use this to try to trade the Mag 7 on a day-to-day basis. That wouldn't be useful, right? But if you're holding Mag 7 in your long-term account and you're worried, this would be a great tool because as long as it's still holding up, there's no reason to ditch those Mag 7 trades. What might be really valuable, we were talking about trust earlier, is you got a comparison button up here, the plus sign. And if you hit that plus sign, you could add something like the MAGs, which is the Mag 7 ETF that I like to use. Or you could use, I don't know, the NY Fang, which is another really good one. Probably this one, since um, I don't think this ETF works in the after hours, and I know this one doesn't work in the after hours. So they would probably sync better. But I'm a big fan of the mags myself. I really love this new ETF. Just choose, well, I like to choose new price scale. Maybe somebody else might want something different. But if you do that and you change their colors so that we can tell them apart, how did the MAG 7 perform in relation to how this ratio moves? Not too bad, huh? I mean, I gotta say, it's not letter to letter perfect, but look at that. That's kind of impressive. I gotta say, I've never done that before, but if you're gonna build trust, look at that. I used to, a guy, trust me, I've had 20 different combinations of the Apple, Amazon, Tesla, blah, 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 and all the different weights. What garbage, an absolute waste of my time. I'll never, ever go through that process ever again. Never. It's a waste. Now, don't get me wrong, 5 years ago, fantastic. We didn't have anything that could compare. But nowadays, I will not waste my time building my own Mag 7 chart. So that's one. What else we got? TDEX. The VIX is falling back down. This is the VIX in purple down below. And this is TDEX up above. The average cost of puts are back to their average level. And the VIX is back down to its previous average level. So there's no threat to the volatility structure at the moment that I can see. And for this one, when it comes to the VIX, I know that spot gamma is confusing. I do, guys. Trust me, I get it. And a lot of the things that it talks about, you may have no idea what the hell it's saying, but it does have plain English stuff in it. Read the the spot gamma reports about volatility because it will help, right? It really will help, I promise. Oh yeah, I mean I had a Mag 7 multiples and I created them, I shared them, I put them in the Thinkorswim workbook. Absolutely. Because back in the day, that's all you had. Nowadays, the world has changed even in just the last, 6 months. We've got all these fantastic, absolutely amazing ETFs. And I'm still developing new tactics for all of these advanced ETFs that we have now. If Jeremy was in here, I'm sure he has a lot to say about ETFs nowadays, right? Like ETFs, there's just so many of them. And the way that you can combine them to look at the evaluation of the things that we can do with ETFs nowadays. Buybacks, dividend aristocrats, equal weight, growth, high beta, low volatility, high dividend, momentum, multi-factor, pure growth, pure value, dividend, select value. You can take any of these, and this is just a scratch of the surface, right? You can combine these ETFs in different ways to come up with fantastic tools to evaluate market dynamics and have a better idea of the risk that we're facing out there. And they come up with new ones every day. The MAGS, MAGS, is one of my favorite modern ETFs that displays and correlates and helps me better gauge risk in the MAG 7. It is way more accurate and consistent and powerful than my own little homemade ETF with strange numbers in the weights that maybe 1 in 50 people even understand where that name number comes from, let alone how to adjust it on a quarter by quarter basis. So then you're just stuck with this long ratio with plus signs and weird numbers in it. I have no idea what any of that means. And that somebody says, "Oh, yeah, that's a homemade ETF for the Mag 7." Okay, I like this better. We're going to skip over core. What we've got here is the IXIC. Sometimes different platforms make you use symbols that are a little weird. This is the NASDAQ composite. It's not the NDX per se. It's the entire NASDAQ, the bigger number NASDAQ. So the white line is cumulative volume. It's a CVI indicator, cumulative volume indicator. And what we're basically doing with it is looking for net buyers or net sellers. On the hourly, it can be a little misleading. So let's push that aside for a moment and look at it on the daily. The markets had that eventful Friday and down we fell. And then when we got here, we chopped about and we've been slowly trying to work our way higher. And then today we had that big pop today and we're up elevated. But if you look at that white line, other than a little bit of a sell-off last week, we set that low. We made new highs in this since then, and it's still pointed to the upside. Net buyers through that whole thing. Didn't even slow down. A little speed bump. That's it. We just kept on going. So when I look at this, what's the trading landscape look like out there? They're still buying. They were still buying here on the hourly. We can see that big day where we fell. They had a little bit of selling, and then they jumped on it with both feet. Now, we've talked about it before. When we use fibs, and we've got that 786 line, and we talk about how when price pulls back, people are taking profit and others are happy to take their place. And so we turn and we go higher. And that's healthy, it's rational, it's normal. But you have to have those buyers step back in. Look at that. They stepped right back in. They didn't wait for us to get back above the mid. They didn't wait for signals or patterns or anything. They just jumped right back in it. and ran it right back up. So they're not decreasing position size, at least not in this perspective. We got a CTA chart that shows, there has been a reduction in CTA positioning, but that's different. So net buying, Thinkorswim has a cumulative volume index. It's not as good as TradingViews, but it does have one. So you just want to go to indicators and type in CVI, and you'll get the cumulative volume index. The one on TradingView, in my opinion, is better because when you choose the market, now I'm on the Nasdaq, so I'm using Nasdaq. But you can build a chart and make it like, I don't know, SPY, and you can use US total, and it will use all of these collectively instead of just the Nasdaq. On Thinkorswim, you can only pick one. It doesn't have the all US markets choice. So in my opinion, it's not as good. But so what, right? It's good enough. You can just go to each one individually. On Thinkorswim, you might have to actually put the words in there. Cumulative volume index. I, of course, have got my own little modded one, but let's show both. This is the Thinkorswim's version of the CVI, cumulative volume index. You just have to use the words, not the letters. And then this is my little homemade one. What I did with mine is, one, I added a zero line. We don't need one on this market, so we could just turn the zero line off. And then two, I put a Bollinger Band around the indicator itself. So this Bollinger is built around the CVI. And then I added some moving averages, the 10, the 20, the 50, so that at a glance I can look at cumulative volume in the NASDAQ and, evaluate how's that net buying or net selling looking. And it's looking pretty good. This does not look like the one on TradingView. They're not supposed to, because Thinkorswim has no obligation to match TradingView and vice versa. I like TradingViews better, by the way. And I shared that if you guys want it. So looking at this, buying is still healthy in the broader market. The Nasdaq is not at risk here. We're still seeing a lot of acceptance of price. People happy and willing to jump in on any pullback. They're still buying the dip, yo. Good enough for me. No threat to the broad market in that perspective. Now this one's a little wonky. I'm gonna have to just share the symbol with you in the chat. I don't think that Thinkorswim has this particular symbol, but I do think you can see the high yield index on Thinkorswim. I just have never dug it out. The reason I say that is because Thinkorswim has like Fred data and other things, and I think you can get it, but I've just never looked. Right. So this is ICE, Bank of America, US high yield index option adjusted spreads. Whew, that's a lot. Just imagine that this is a liquidity tell for overnight repo and that sort of stuff, right? I know that might seem like we're reaching here a little bit, but we're just trying to see how the plumbing is when it comes to banks and government and companies' ability to make payroll and short-term borrowing and lending. If liquidity is at risk, the markets are headed down. If this starts to climb higher, which is where things go wrong, this going up is bad. And I've often thought of flipping it over just so that down is down and up is up, and that would be less confusing to people. But um nah, So I've left it alone, but I probably should, really. It would be less confusing, right? Just like I flip the VIX over a lot, and I think that helps people understand it better. Look at April when the administration was threatening, global tariffs and blah, blah, blah. And look how high this was. We had a real liquidity risk back then. And then look at where we are now. Nothing, right? And sure, we had a little blip here. Things got a little excited. Remember 2 Fridays ago, the big red bar and it fell down and markets got a little worried. So we popped up, but we've already come right back down. I've got my swag level 2.92. We're headed in the right direction. The concern here is that we're going to bounce on this 95 and we're going to start trying to work our way back higher again. So there's a little concern, yes, but in the grand scheme of things, when we zoom out a little bit, we got back inside of that high. We're working on getting back inside of this high. And as long as we're still in this lower zone below this 3.4, I think we're fine, right? I don't see any real risk to liquidity yet. But this is a good one to keep around, right? It doesn't cost you anything. Well, if you have trading view, it's a good tell on liquidity, right? You just keep an eye on it. You don't have to stare at it all day long. Peek at it a couple times a week or after really big news and see that we're not getting something really extreme happening, and you're good, right? That's about all it needs. Just a little maintenance once in a while. Take a peek at it. We're fine. You can see historically, take COVID for an example. That was really bad. Or the 2022 bear market. We had some highs up there. We don't have any liquidity issues right now, right? So that's just another tell. Think of banks, lending stress, liquidity fractures, um, and that will go directly to gold too. There's no issue here. All's good. So that's a really good one to check out. While you're typing it out, you'll notice that there's other choices. Like this one has M2 behind it. I think you can choose something else, and that's the M2 money supply. That's not like I don't know, 2 month or something. It's the M2 money supply. So it's a weird conglomerate symbol, but it's one worth adding. Yeah, that's the same one that I put on there too, isn't it? I, are you putting in another one? Oh, I got you. No, 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 I got you. Yeah, zeros and the letter O. Yeah, what a nightmare, right? Get those mixed up. They're really good to use, for secure passwords, but it's a nightmare trying to figure out what somebody else's numbers or letters are. I don't know that one. Let's build that. Not on this time frame. Yeah, I have been working on it. I wanted it all done before I posted it into that Discord, but I have been building it. because I'm also doing it for my stockcharts.com account. Because Stock Charts has charts that you can only get at Stock Charts, and I know some people have Stock Charts, so I've been doing it there too. I haven't forgot about you guys. Hmm, might dig a little bit into this one. Thank you for that one. You might have heard me say the phrase before, flight to safety. This is a MACD down below, by the way. A flight to safety is exactly what it's called. And if you Google ratio charts flight to safety, you'll get a number of different choices. I like this one. This is staples versus consumer discretionary, frivolous spending versus, staple, I guess is another way to say it, necessity needs, but flight to safety. If things were going bad out there, we would see money rotate, and this would be pointed to the downside. Look back at April for an example, where it had dominated to the downside from like 2025 December into January, New Year, down we went all the way to April, and then this run back out again. So this is a really good tell. Um, this is missing my year-to-date anchored VWAP. I normally have that on there. I don't know why it's not there, but this is another one to have as a tell for, are we above? Are we below? That sort of perspective. Set it for the year. Get rid of those bands. I don't like that stuff. Much better. All right, XLY/XLP. You can do it the other way around if you want to. I like it this way because when the markets are down, this is down. So this is like the other one, the growth versus value. When it's going down, it means P is in control or outperforming. And when it's going up, Y is outperforming. But don't make the mistake of thinking, well, it's going up, so staples must be going down. Or, oh, it's going down, so consumer discretionary must be going up. It's just which one is outperforming, which one's doing better. They can both go up at the same time and they could both go down at the same time. This is going to tell us which one is outperforming. In this scenario, I think I chose the anchored one. I chose this one, VWAP Auto Anchored. It's made by the TradingView platform. It's not a custom one. And that way, when you double click on it, it gives you the choice to just choose the year, which is really nice. Thinkorswim has that now, by the way. We've run custom VWAP for years on Thinkorswim because they did not have it, and now they do. Yay! So you can build out some really nice anchored VWAPs on Thinkorswim using Thinkorswim indicators rather than custom Thinkorswim indicators. So with this one, it's just like growth versus value. You want to see who's outperforming. Is uh, is consumer discretionary outperforming staples? Because if they are, everything's fine, and the market should hold up really well. And we don't want to try to short the broader market. If they're not, then we need to downsize in our longer term longs, and we need to reevaluate where the threat or the risk is coming from, and maybe tighten up and all that good stuff. We do need some sort of divergence signal, whether it's RSI, MACD, stochastic, something down here. I've got MACD on at the moment, but I really like my stochastics. And to me, it doesn't matter one or the other. Just, have something down here so that if there is some sort of divergence, you're able to spot it. We pulled back to the zero line. So you can see the crossover. That was a really solid indication of risk before the tool even fell because we started to flatten out there and they were running together equally. But under the surface, things had already started to fade. Then we fell off. We found some structure and we're turning. I know you can't really see it that well, but it is trying to turn up at the zero line. If we get a bullish cross here at the same time that this starts making a run up, I think that'd be a really powerful signal right off of that midline. That'd be fantastic. If we don't turn up and we go ahead and we get on down, I mean, it could get a lot worse, but nobody's expecting that, right? It would have to be some drastic, radical news rather than systemic change to market outlook, which is what it would take, right? Radical news or broad market change in bias. And looking at this, we don't have a broad market change in bias. We just had a little bit of risk. The Mag 7, I mean, it's earnings season, people are going to get scared. They're going to dump some of their Mag 7. And so we have a little weakness here and we have a little weakness in the market. We're stagnant and sideways. We're still well above the anchored VWAP and we held this previous high, not by much. I mean, we're there, but it does count. 3.0 is better. There we go. I would say our own low is a good line in the sand. If we get below that, it's not good, and that you would probably want to tighten up some more. But it it isn't a signal to short the market, right? This is just a signal for what is dominant, who's outperforming, staples or growth. Because consumer discretionary is a great representation of growth, and staples are a great representation of value. That's why we want to look at multiple charts, right? Growth and value. All right, so this takes a little bit of explaining. There are some fancy terms called backwardation and contango. If you trade options, you're probably familiar with this, that when you go out 90 days and you look at the cost of that option, it's way more expensive than your 9-day option. And that's because things farther out in time are generally more expensive, right? That's contango. That's the way things are supposed to be. So a lot of cost farther out. We'll put three of them up here to represent lots. Here in the middle, it's not as much. So, maybe put two of them. And then way close to where we are in time, we've got one, right? So the farther out in time, you got more cost, more risk, everything's more expensive. If that changes, we get backwardation, which is where things in the front end are really expensive and things in the back end are less expensive. When that happens, it's because people see so much risk immediately right in front of them that they get scared and they start buying up a lot of puts. So when it comes to volatility, buying a lot of puts increases that volatility's image and it gives us this backwardation look. Well, what I have on the screen is a 9-day VIX versus a 1-day VIX. There's a lot of VIX tools out there. There's a 1-day, a 9-day, a 30-day. I think there's a 1 month, right? If you could just get one M instead of right. But I had someone ask, is there a 1 month? And I think there is a 1 month, right? Like the VIX is a 30-day. So you should just type in VIX and you'd get a 1 month. But depending on what platform you use, you might find one that actually has the 1M. There is a 6M, that's 6 month, and then there is a 1 year. So, yes, there is a 30-day VIX where it just says 1M, but a VIX is VIX. So if you just type in VIX, that's your 30-day. What we can do with those tools is we can mix and match a lot of ways. This is a backwardation measurement. If the VIX 1 day, which is the real short end, if it's outperforming, we go down. And if the VIX 9-day is outperforming, this goes up. Now remember, it's not about when it comes to these ratio charts, it's not about we think one is going up and one is going down, just which one is outperforming. Who's getting more flows? And this is one that I do look at on an intraday basis. I don't even know what it would look like on a high time frame. Ooh, yeah, that's a mess. On a day-to-day basis, there you go. Go back to April when the capitulation and the tariffs and all that. It was all the way down below one, below zero point 0.8, got all the way down to 0.7. But on an intraday basis, you want to see who's outperforming the short term 1 day or a little farther out the 9 day. So that if it's a sideways day and we're just chopping around doing nothing, there's no threat or volatility in there. And then if it's an expansion day, do we have any threats or volatility in there? It's nuanced, it's weird. This is some of those newer ratios. Some of these old ones like growth versus value, that thing's been around decades. This is much newer and more nuanced. It's just a intraday representation of performance in volatility. So that won't help us in the bigger picture of how's the broader market doing. For that VIX picture, I've got a tool for that too. Mag 7 again. This is FNGU with FNGD. I mentioned how nowadays there's a lot of tools out there that are really new, these new ETFs. And there's a new ETF group, or maybe it's an ETN called FNG. Now, this is the micro NYSE FANG Plus Index Futures. It's the FNG. That's the symbol right there. But if you look down here, it's got the FNGU, which is the +3 leveraged ETN, and then the FNGD, which is 3x inverse leveraged, right? So what I decided when I found out that we had all of these, like, now that is so freaking cool, is I took it and ran them into a ratio up versus down. Uh, Not really a favorite, just different perspectives, right? This is like, it doesn't say it here, but this is my up volume, FNG up volume. And I read this as volume, even though that's not what it says. So, how's the liquidity out there, right? FNG up volume versus FNG down volume. If you only want one and you don't want to go to anything else, then just look at the IWF versus the IWD. That's your best Mag 7 tool right there. That would be the difference between building your own furniture and just getting something from IKEA. Put it together, it'll work for a little while, and then eventually it's going to break and land you on your butt. But hey, for a little while, life will be easy. So just run that one. No, let's keep this one. That way I can add things to it. Another new ETF when it comes to Mag 7, we got Mags versus Top. Top T is a new indicator that's using the top 20 names in the NASDAQ. It's also a really good trade list, by the way, but it's just the top 20 names. And if those top 20 names are doing good, well, obviously, so is the Mag 7. But is the Mag 7 outperforming the top 20 names? And that's what this ratio is doing. If we turn off the S&P, there's the ratio. If the Mag 7 is outperforming the broader market, then this will go up. Or let me rephrase that. If the Mag 7 is outperforming the top 20 names in the NASDAQ, this will go up. And why does that matter? Why can't we just use this, like the Mag 7 against the QQQ? Which, I mean, you could, but the the NASDAQ or the S&P, the full basket of 100 names, you got some laggards in there. They drag their feet. They've had a bad quarter. They're getting sued. Whatever. It's a big basket. This, the top 20 performers. Well, the mag's in the top 20 performers, right? It's a part of those same 20 names, but it's the other 12 names or 13 names. You guys might have heard this before, that it's not the S&P 500, it's really the S&P 7, and the other 493 are just there to fill in all the holes. Or the Nasdaq 100 is really just the Nasdaq 7, and that the other 93 are just there to fill in the holes. But you could branch that out and say it's really the top 20 names that make up the index, and everything else is just fillers. So why compare the mags against the entire index when you could compare it against the top performers and see which way this is pointed? And that, to me, this is a shorter perspective, because I like the big ones, the old ones, these, but this is a lot broader of a perspective. I would use this for my long-term accounts. I would not use this for my 6-week trades, so to say. But the shorter one, the Mag 7 in the top, I do use this for my shorter term trades. 6 weeks, 2 months. How's things looking out there? Weak, not weak. We're going to hit resistance soon. We fading into support. I look at this for my shorter term trades. Not day trades, obviously. That this doesn't have that context, but short term swings, yeah. And it has kept me out of trades, and I'll take it any day of the week. If I see risk in this and I was going to, get into Google or Microsoft, and I see we're about to hit resistance or bounce on support, it readjusts my perspective, and it can talk me out of a trade. Yep, that's exactly right. Yeah, that kind of divergence is the stuff that I want to spot, and it helps out. There's more like a trade yeller. Someone called me. What did they call me today? Oh, the Billy Bob Thornton of customer service. I can say it. I don't know if people are going to like it. I don't think I'm as bad as Billy Bob Thornton, though. I mean, come on. I'm not that bad. This is the S&P 100 advancing minus the declining issues. And in the mornings, it's a really helpful tell from like 9:30 until 10 or so. And because, after 10, we got enough candles, we can snap our own intraday lines. But if you're trying to get a read between 9:30 and 10 or 10:15, this is a really good perspective. It's just advanced decline, but it also has capital and volume in it. So you can get a little tell if we're divergent with, say, the S&P going down, but more advancing issues coming in than going out, with more money going in than out. It's going against what SPY is doing, showing you the broader market might be going up, or that more money is going up even while SPY is going down. It's a nice little tell. And there's a lot of indexes you can swap that out with. And these stack really nice because you can pop it out, pin it, pick your index. It's got a NASDAQ 100, an S&P 100. Then you can make your own Mag 7 and you can stack these things up into tiny little windows about yay big and build out a whole list of them. Sorry about that bright screen. I should have warned you guys. In the top part of this is the civilian unemployment rate. It's set on a 1 month Bureau of Labor Statistics. The average rise when things start to go wrong is around 4%. Down below, we've got gold and silver miners, and then we've got the 7-year rate of change for the unemployment. And you can see that the rate of change is picking up. And until we ran out of data, things were starting to pick up here. Now we're not back at risk in this yet, right? The blue line is still way down here. That's the rate of change. But the gold and silver miners, I mean, look at that breakout. That's like never before seen levels. Barely, but barely counts. So this is um, it's not turning around. It made it through resistance. It's still pushing higher. That could be a risk of just being overstretched or overbought, but otherwise, we don't have data up here to correlate with this, right? The with the government shutdown, we have all missing data, so that only has limited value. All right, I didn't build this chart from my own knowledge. I found this chart on oh, I want to give credit. I can't remember. I'll find him on Twitter. He's a guy who's been around for a long time. He's got a career in macro, and he says we get a confirmed recession signal Once the permanent job losses, PJL, 14-month RSI is above 60. So you put this on a monthly chart. You set the RSI to 14 so that you have a 14-month RSI, and you watch this gauge down here to see that it gets above 60. We're at 55.26. We're not at 60. So, we're moving in that direction. Recession eventually will come. We all know that. We're not there yet. All right. So that I'm willing to share this chart. It's this number right here, the unemployment level. Just copy and paste that out of the chat, and then just set your RSI. Put the chart on monthly, not 3 month, because that's your choices, 1 or 3. Set it to 1, and then put the RSI on 14. Add this note so you don't forget, right? Because I don't remember this stuff. I have to leave notes. Put that note on there so you don't forget. And I'm gonna try to find this guy's name because I don't want anybody to think I'm trying to take credit for somebody else's work. All right, now this is a real big one. Also, I keep it on a monthly. I never go lower than that. We are hitting a big key level of 3.42. This is the NASDAQ versus the SPX. Only instead of using INDX versus SPX, it uses IXIC versus SPX. This is a tech indicator. So all things tech, old tech, new tech, medical tech, just tech versus the S&P. I use this as a read for the Mag 7, yes, but also junior tech and older tech like IBM and that sort of stuff, just tech in general. And you can get more specific than that if you do see weakness. You could go in and try to find, is it software? Is it, machines and hardware? What kind of tech? You can always dig deeper to find out answers, but I don't generally go digging unless I see weakness. And I watch for critical levels. So when we're in all-time highs, all we got are fib lines. But when we're inside a range like we are here, then critical levels are previous areas to focus on. Mag C is the Mag 7 of China. You're awesome, dude. That is definitely going in my notes for an evaluation this weekend. Heck yeah, we needed one of those. Absolutely. So we're through the liquidity cloud. We've got this reversal level that I've had marked for a while. We're there. I'm a little concerned, but it's on a monthly, and we broke out of last month's candle, and we're at the high of this month's candle. That's not a short signal. You know what I mean? Like that, does it have risk because it's moved a long ways, yes. And there's something called a 5 bar rule. And sure, that could give you pause, but it's still green. And we're not at the top of the channel. We're just hitting an arbitrary line that I drew, and there's room to go, right? So we could pause here, we could digest a little bit at that level, but unless it starts turning red and then we get back inside the previous month's range, there's no threat here to tech stocks. I wouldn't try to short tech stocks in general because of this. And it's a really nice tell. It rolled over really nice before the 2022 bear market. Look at that rollover. It topped out in like July of 2021, right? And in the early part of 2021, it topped out, but then it chopped through most of the rest of the year. Then it really started to pick up in '02. So, keep that one on your radar. IXIC versus SPX. And so again, broader market, everything's fine here. There are some really good charts that I use at stock charts that I'd like to bring in. I don't show stock charts very often because you got to pay for it. Even TradingView with no account, you can go there and you can look at a chart. You know what I mean? Like it's accessible, even though a lot of people they just go ahead and buy a subscription. You can use it without one. It sucks, but you can do it. But when it comes to stock charts, you're really limited to be able to use it. So I don't show it very often, but there are unique charts on that platform that are really helpful for evaluating things. And then there's just good old fashioned breadth charts, like how many stocks are above their 50-day, how many stocks are above, their 20-day. And those breadth tools are really powerful tools. They're old. Oh boy, they're old. They've been around forever, but they're still really valuable. If you're on Thinkorswim, let me sum it all up with this before we get out of here this weekend. You've got an enormous set of market breadth indicators on Thinkorswim that you may not even realize are there. You see the drop down arrow right here. So when you hit that drop down arrow, go over to indicators because you got all these choices right here. But the one you want is indicators. And if you look in that list of indicators, it's market breadth indicators. These aren't like MACDs and stochastics. This is things like tick, trend, AD, UVOL, DVOL, stocks above their 50, stocks above their 200. It is a fantastic collection of market breadth tools. How many stocks are making new 1 week highs, 1 month highs, new highs on the year, new lows on the year? There's a lot of old school analysts that live and breathe based off of these numbers. They use them extensively. Now I use more modern stuff most of the time, but it doesn't mean I completely ignore it either. On stock charts, they have a lot of guest speakers that like to point towards these older signals. And so you get more familiar with them because they show them a lot and talk about them often. You can go to Stock Charts YouTube, which is free, right? And they got Stock Charts TV free. And you can learn a lot about market breadth from that stuff. And then you can come over to Thinkorswim and you can see a lot of the old school charts. But I'll show you some stuff that Thinkorswim doesn't have and that I'm pretty sure TradingView doesn't have. Next week, we're going to bring out my stock charts account. We'll take a look at some tools like the Bullish percent index. There's a number of those indexes. They've got one for gold miners. They got oil bullish percent, and then of course the indexes, the S&P, the Nasdaq, the Dow, the Russell, bullish percent indexes. You can do a lot with that ratio. It's fantastic. But as far as I know, it's only on, stock charts. So useful tools though, for sure. Um, unless you guys have questions, it's after 4 and I got through the charts that I wanted to get through. I answered the topics that we had on the agenda today. So I'd say that's a good place to wrap up. In the big picture, we don't have big risk signals. We don't have any weakness signals. Woohoo! Furlough. All right, everybody. If you no, shoot, I forgot to close it. I was streaming. Oh, I just might got signed. I forgot all about that darn thing. Oh, I definitely got assigned. I think the only good thing is that all 3 legs were in, so they cancel each other out. That's what I was thinking. Maybe. It took my order instead of just immediately saying you're screwed, which is what it would have done if it was the SPX. And I can't offer, well, I guess I could. It was trying to fill for a penny. So I can knock that down a little bit more. I wish if this platform offered market on close, I would try that. But it's not think or swim. I might have to try to close it individually. Nope. It's throwing me all kinds of errors now. Right? Now it's rejecting. There it goes. All right. The queues are closed. Whew. Thank you for asking me that question. Oh yeah, that's a max loss. Um, but butterflies usually are, right? They're usually hit or miss like that. You either get it or you know, if it's a longer term butterfly, you've got a better chance of doing something with it. But I put that one on yesterday and such a short term butterfly, you're messing with an all in, all out sort of a situation. I debated yesterday. I was gonna skew that to be a ratioed fly and skew it to the upside, and I should have just went with my instincts and did that. It was a bullish one because we were at 607 or 608 when I put it on, and it was a 613 butterfly when we were at 608. So it was bullish. But we opened way above my 613, right? We opened at like 616 and a half or 617. So it was crushed by the time the market opened this morning. Yeah, there's a lot of ways that you can adjust a butterfly. It's one of the reasons that I like them. But typically speaking, for me, when I put on a very short duration trade like that, I'm going to treat it as all in, all out. And I have no interest in going in and adding risk to the trade to modify it. What I could have done, not necessarily widen the wings, I could have just moved one of the wings, right? If you think about, let's just build that. We'll build one that has some time on it still. It was out of the money, so go in and do like a just a regular butterfly. If this is the trade, and we'll say instead of getting run over, we'll say I didn't even get it on yet. Yeah, you exactly right. You break one of the wings off. So the idea would be that you roll one down or up to change the direction so that it's no longer a neutral position, right? In this case, we're above the market and I would want something down here. So you break one leg off and all you're doing is you're taking all that risk that was here. You're not getting rid of it, you're just moving it. You you move it over here. So the threat is always there. You just shifted where the threat lies. And that's absolutely something viable is to take that trade and, you know, spend more money on it. But that's the beauty of options. You can take any trade, no matter how wrecked it is, and you can fix it. How much more risk you have to take becomes an issue, right? And I'm not willing to stack, say, $2,000 more risk onto a trade to avoid a $50 loss, for an example. So, at some point, you have to weigh, is it worth adding this additional risk, or should I just take my hand slap and lose the 50? In this case, I saw we were run over this morning. I could have closed it when it was only at a 15 or $20 loss because it wasn't a max loss at the open. I checked it and it was down, let's say 50%. It was down 50% at the open. And I'm exaggerating a little bit. So what? I could have easily taken a $25 loss and moved on, right? But I weighed the odds on that and thought, we could reverse today. Let's see how it goes. And by lunchtime, when we ran back up and got above VWAP, and it was pretty confident at that point that we weren't going to sell off without a really big surprise, I knew I was screwed. Yes, I could have broken the wing real time. Yes, at any time, right? An options trade is no different than any other trade. You can open it, close it, adjust it, roll it. As long as the trade is still open, you can still do what you want. Oh, yeah, absolutely. When you go to do it, if you're going to start doing it, maybe first, instead of moving any of your strikes, think about adding to the trade. And I'll use this one for an example. We have 22 as the center point, and we're $1 wide. And if this trade wasn't working because price is underneath this, what could I do to add to this trade? You would add another credit spread. So now it's not a broken wing fly, it's a ratioed fly, right? I put a credit spread on top of the existing butterfly and made it a ratioed fly instead. And the reason we call it a ratio fly is because I changed the ratio of the contracts. It's no longer a 1-2-1, it's a 1-3-2. That one's really popular. And when I would do Benzinga boot camp webinars, this was the one that I always took over to talk about because it's so versatile. If we had got run over the other direction, we would have put the number on the other side, right? So that we can point it in any direction we want to point it. And so that's really handy. If you learn that one first and you get really comfortable with it, later on, you could start messing with breaking your ratio or breaking your butterfly apart and spreading one leg higher or one leg lower. In Tasty Trade, I believe what they always talked about is rolling the untested side, right? So usually they use that phrase in iron condors, but this would work too. If price was here in the middle and we built the butterfly around price and then price decided it wants to go to the downside, you wouldn't try to fix the put. You would leave the put there and let it lose or do whatever it's going to do. Instead, you would move the call and you would roll that call lower. Now, when they talk about doing that, their purpose was because in an iron condor, you sold to open both sides and you would roll one side lower, taking profit in your credit spread that has made money because price went the direction you wanted it to go. We're talking about buying these wings and selling the body because it's a butterfly. So you would be rolling a long call lower, or if price had went up, rolling a long put higher, because that's how the roll would happen. And I don't know that you would, depending on when you opened the trade, I don't know how much profit you'd have in that call or that put when you made that roll, or how much life there would be left in it. I'm not sure, but it comes to mind that when it comes to this sort of trade, I know Tasty always talked about don't look at the side that's losing per se, look at the side that's not getting tested. Because if you move the put, price can just keep running away, and then you got to keep running the put, and you're fixing a loser every time. It just costs you more and more and more money to fix that loser. Let that loser lose whatever it's going to lose and continue to lock in gains from the winner that is winning, right? I don't think that applies well to a butterfly, though. I think I like that better, Austin. I really do. Treat it like the verticals that it is, because this is a long vertical and a short vertical. I think I like that better. But the easiest fix for a butterfly is to add a credit spread. Really, I'll stick to my original answer. But yes, you could have broke a leg off. Iron condors are pretty awesome, but I'll tell you, if you want a trade to study to add to your arsenal, the butterfly is hands down the best. It's the cheapest one out of the lot, and you can do a lot of fixes with butterflies. But the other one is a diagonal. They don't get elevated enough. Diagonals are fantastic. I love them. Oh, I don't know. Austin, I was the same way. When I started, I couldn't read charts either. I was new, like everybody's new at one point, and I spent all my effort on learning how to trade options. I had not read one candle book. I never watched any videos on technical analysis or how to read charts or how to use indicators. I went right after options 100%. All my effort was spent on understanding and trading options. And I worried about technical analysis later. Like I just figured options are a statistical product. I'll run my statistics all day long and worry about reading price, later. That's exactly what I did. It worked out perfect for me. Yeah, diagonals are awesome. You do like a double diagonal, you can get a much wider range than an iron condor with a lot more money too. More money, less risk, wider range. What's not to love? Yeah, there's the two sets of classes. Um, well, there's the set on the Bullish Bears, the next level trading library, and then there's the intro to options and then intro to advanced options. The advanced options is on the website. The intro to options is on YouTube, I think. If not, I've got the links to all of them right here. But I think they're on the internet. Yeah, intro to options, YouTube. But the advanced options are on the website in the next level trading library. And then, of course, the 20 videos on volatility. I thought about making a video on how to make pound cakes, but it didn't fit into my YouTube channel. Have you guys seen PAX Day yet? It's a computer game, MMO RPG. It looks amazing. It sounds like a good way to not mess with your stops when you got a trade going. You know, you got to stay busy. It's called PAX Day, only the word day is spelled um D how's it go? DEI. It really looks good, and they just opened up. Now they've been running like beta for a while, so it's not like they don't already have existing communities, but it's fair game right now. So you know, a lot of those MMORPGs they've been around forever, and you know, like decades. This is straight up new. Yeah, I think you're making it harder than it needs to be too. You know, we all do at some point. We get hung up on something and we just it just becomes more difficult than it needs to be. But that's the work is not in vain. I think that your journey, anybody's journey, on the other side of it, you'll be much better off. And the next thing that you go to learn, whatever that next thing is, you're going to do it better because of this, right? So you're going to get more out of it than just the fibs when you're done. You're going to pick up some tactics and some learning approaches that will benefit you later. Because every new thing that I've learned has made me a better learner for the next topic. And then I learn that, and I'm a better learner for the next one and the next one. So for me, my trading view charts, guys, naming conventions are a really big deal. If you've seen my Think or Swim videos, you might have seen me talk about this before. But naming is a really big deal, right? Organization to be able to find the charts again. I found out that when you name your chart, you can use emojis and icons. So I group my charts based on that. If you look, I've got these little, like, I don't know, road signs, construction signs on some of my stuff. I've got lightning symbols on my volatility stuff. So come up with an icon table, and then the charts that you build, put them in the icon category that they belong to, and that way they should fit together and stay clustered together. I hope that makes sense. Because if you just use letters and numbers, I don't think it groups the way that I like, right? I did not, but um, when I'm streaming, I'm kind of tunnel vision. Did you post it in the questions channel? Oh, I got it. I found it. I just found it. And I'm going to ask you for a clarifying question here in just a second. Next week, guys, it won't be Wednesday that I stream because I don't stream on FOMC days. It will be Thursday, the 30th, and then Friday. Now, that's a rough estimate because I might do Tuesday. It really, if I can get it, I'm going to try to do Tuesday and Friday. That way I'm not back to back Thursday and Friday, but I'll let you guys know on Monday. But either way, it won't be Wednesday because Wednesday's FOMC, right? So we'll get that figured out. But I wanted to give everybody a heads up because I try to stay as consistent as possible. You know what I mean? I want to be here every day that I'm supposed to be here and not just fail on you guys. So I'll try to give you a heads up as soon as possible for next week. Now, on this question, um, I assume you're asking about this stuff, right? The options statistics down in the bottom, or are you talking about all of it, the product depth and the options statistics? Because we can do both. I'm good. I just wanted to know, what you're focused on. Oh yeah, yeah, yeah. Just the statistics, absolutely, all of it. Gotcha. Because um, I didn't always have accounts to all these really fancy places, and I was quite comfortable with just this. I mean, it's not perfect. It's so much nicer to have tradie ticks and spot gamma and all that stuff. But a lot of times I'll see a tradie ticks post and I'm like, yeah, well, what does that mean? Are they buying them or are they selling them? And I'm doubtful. So what do? I come right back into Thinkorswim and I look the trade up because I know what the hell I'm looking at here with tradie ticks is just some alert that says a bunch of calls were traded. Yeah, but did they buy them or sell them? Like I don't know. I got to go look. So this is really helpful. Plus, you can see gamma squeeze from right here, and gamma squeezes are awesome. Just look at GameStop, right? That whole GameStop Reddit rip, the whole thing, that was a gamma squeeze. And if you can see a gamma squeeze from right here, you want to know how to do that, right? And that's Heck yeah. Who wouldn't want to know how to do that? So, tips and tricks. We'll get into this one. That's one thing about Thinkorswim. The guys that built it have done a lot of talking over the years about what they put in here and why they did it. And I've had the fortunate pleasure of listening to some of those guys chit chat together, kind of like how the kids sit back and just let the grown-ups talk. Yeah, I've just sat back and listened to some of the guys that built this thing chit chat before, and I've heard some things along the way about this. It's on the list. We'll get into it next week. There's some really good things in there, very helpful things, not just the gamma squeeze, which is nice, but we don't get them very often, you know. Be nice to know all the other things that we can use more regularly than that. It's really helpful at a glance. I mean, it gives you so much information. I looked at your picture. Your settings aren't much different than mine. Have you already changed your delta values, or because your delta values are the same as my delta values? These down here in the bottom, these five numbers. I don't think these are default, right? At least I could have swore I changed mine sometime along the way. Maybe they reset on me. Yes, you absolutely can. If you hit this gear icon, you can choose where you want those five to be. I guess mine did get reset somewhere along the way. And the add marker is new to me. I don't remember seeing an add marker there before. I guess five is all you get. So you maybe you can delete one and then it's not letting me do it. Huh. But yeah, you can apparently mine are default too. But yeah, you can space them out because why would you want to? We'll get into that next week. Get me going on this thing. Well, we'll be here till midnight. Everybody, have a good weekend. We'll see y'all next week. Let, that sounds good.